It's time for Money Making Mitch. When investors need a story, we're going to the moon. Welcome to Money Mitch, where story is everything. I'm here to find you the next opportunity. It's all about the green hands. Now we all know the bull market is here to stay. Money Mitch. The old-fashioned mute button there. Let's go ahead. Let's dive right into it. Let's take a look at what we saw in the market right now. A lot of stocks moving because of earnings. We'll get into that right quick. Let's take a look at the SPY and see what we're seeing here. As you can see, guys, we are pushing on up there towards the close. Just a quick rally into that 3 p.m. We know how that 3 p.m. sometimes sticks out, institutionals putting in those last-minute orders there. Definitely you're seeing that trend into the close. The question is, will that hold tomorrow? We'll definitely keep watch. Let's take a look at the daily levels. We've been talking about this red zone that we got back into when we started coming back down to those March lows. The real question is, do we really get closed down there below 410, below kind of that low here on exactly that was on the 24th of February, the low being there 410.64. Today we got down towards 405.02, but definitely closing up back over here. So we'll keep watch to see if we close underneath that red level for us. Of course, today it was kind of an interesting move because at the beginning of the market, you saw the Qs start pushing on up. It was looking good there for the semiconductors, and all of a sudden it started coming back down. Then towards the close, that's where I saw a lot of the strength come back. Names like NVIDIA, names like AMD, QCOM are some of the names that I was watching. TSM. I was talking about how these were looking strong here out the gates, and then they kind of gave up that strength. Then you saw it really quickly come into the close, and you can see it here, like you see on TSM, a lot of that action coming in there, some buying imbalance there. Coming into the close here. We'll keep watch on these semiconductors. Let's go ahead. Let's take a look at the technology, of course, leading us up here from the open. Consumer cyclicals behind that, and energy coming on back there today. XOM having a good day. You guys saw the Warren Buffett comments from Chevron. We talked about that and highlighted that on pre-market prep. Of course, adding to the position here. We'll see what happens if these can continue making moves on up. A strong day overall for these. Even ConocoPhillips making a nice little push into the close. We'll see if these start coming on back, or was this just kind of a relief rally as we've been seeing oil taper off. Of course, you guys know how I like sticking with sectors, and one of the areas that I have been seeing get stronger is the industrials. We did get a little bit of a pullback by some of the farm and heavy constructions. So I would definitely keep an eye out on looks like DE looking good here on this pullback. CAT also looking good here on this pullback. We saw these stocks break on out. Now we've been seeing them pull back. The question is, are these going to be the stocks that rally into the end of the year? One of the things that I've been looking at is, of course, the infrastructure bill and how that could be playing into these at the end of the year. Of course, high inflation weighing in these right now. Interest rates could affect these, but I will keep watch on these because I have a feeling that we're going to start seeing a little bit bigger focus of industrials later on in Q3 and Q4. As you guys are seeing, CAT has been pulling on back. I'm looking for a level below the 210s into close towards that 200 to jump in on Caterpillar. We'll see what happens if I'm able to take a trade like that. Let's go to some of these earning plays. Today we had a lot of action that was coming here after the close. I'll put up our earnings calendar here so you can see these, and you can see Avis, MGM standing out here for me, Clorox. We'll take a look at some of these, and even Mosaic, as we've been a big recent mover. So let's go ahead. Let's take a quick look at some of those. MGM was one that I talked about it. I even threw it up in the chat. I don't know if anybody caught that. That was one that I was looking for it to have a good report. I actually tried to trade it today, and it got stopped out here at the open. It started coming back down there below the 41. Didn't want to be a part of that move. Got out. But as you can see, nice rally into the close and good numbers here as it's pushing on up here. I have the numbers here. Looks like we beat on the EPS at 1 cent, beat the estimate of a loss of 7 cents. And also on the earnings, we got a sales beat of 2.9 billion, beating the 2.78 billion estimate here in MGM. We could take a look at MOS, also Mosaic actually coming on down there. We could definitely take a look at some of those numbers. Let's see what we got in Mosaic here. Looks like we got an adjusted EPS of $2.41 in line, but sales here at 3.9 billion, missing the 4.08 billion estimate here. And you can see Mosaic taking a little bit of a drop from that. Another one that we're going to take a look at, maybe Clorox. So Clorox is CLX. And so we look at here. Let's take a look at this one because, of course, one of the areas that we've been watching is the consumer defensives. How are those doing through this inflationary environment? Let's see. The adjusted EBITDA is the earnings per share was at $4.05 and estimated was at $4.18 here. I have a range here to 430, so it looks like we're still doing some numbers here. Maintains the future, the fiscal year 22 sales expectations of a decrease of 1 to 4%. You're seeing a little bit of a pullback. We'll see how Clorox really reacts on this. Daily chart has a huge shadow on the up move on that last down gap. So we'll see if it even gets on up there. It looked like it was trying to get up there. Now it's heading down below those numbers, which were the 140s when it cracked down there. All right, let's go ahead. Let's take a look at what else can we see kind of moving into it. One of the areas that I have been seeing really get hit hard is the basic materials. That's one area that we're going to keep on watch because why? Because I feel like this was, kind of holding our market up for a little bit. We were having energy moving. We were having basic materials moving on up. Now we've seen a complete kind of turn around from these basic materials. You can see here, coal has been kind of the hardest hit and kind of the favorite. BTU really coming out of favor here. And really it all started with this first down move, but then breaking the trend on April 22nd. So it's been a little bit of a down move here from the top. You're talking about what? Now you're looking at like about 36%. So we'll see if it starts to catch some support here near the 20s. And do we get a move back up in these basic materials? But right now, seeing relative weakness. Now, one thing that I have been keeping an eye out, of course, is, our market breadth and how we've been behaving in that. Today, we got a little bit of a bounce back towards the close. But if we take a look here, I've been watching the SMA 200. Now, only 20.9% of stocks trading above that SMA 200 and even lower on the SMA 50. It's at 19.8. So that all this showing me what more of a bearish trend still. Yes, we're getting these rallies, but we're still in kind of a deep bearish trend here. We'll see if we can get on out of here. Coming up next, guys, we'll be getting into an interview. I'm super excited to go ahead and get an interview with Sam Stovall. If you guys are excited for that, stick around. We'll be getting into that interview in just a few seconds. Let me catch up with the chat. What are you guys talking about here? Looks like we got a lot going on here. Some people are talking about the rally. Some people are talking, of course, about REDBOX. Let's take a look there. REDBOX was one of the moves of the day. This was a hard one. I will tell you right now, I was even looking at it to try to maybe potentially take a trade on this, but when this started cutting through here, and it cut through fast on this, it cut through that 684 level. I was watching it to see if it was going to recover 7 for maybe a shot, but it halted on the way down there, going towards the 650, and then coming out of the halt and then just completely ripping towards the upside. Those are going to be one of the hardest moves to trade. Like always, we got to understand when we have these low float stocks moving, because that's exactly what happened in REDBOX. It was a situation here when you get these SPACs that kind of have high redemption and the float size goes and shrinks so much. That's when you're going to have these high volatile moves, especially in these SPACs and de-SPACs that you saw here. REDBOX getting the lift. The question is, will these gains kind of continue? I'm not the biggest REDBOX fan, but we'll see what happens. I did see that they were going to put out a free rental with T-Mobile on Tuesday. So I don't know if some people were watching this, but definitely some people watching REDBOX today. And it was very volatile. I mean, if you take a look at it here, nice patterns on like the 5-minute, but the 3-minute and the 1-minute for all those kind of momentum traders that were looking at it was very much volatile. I mean, look at this turnaround here from 1050 all the way down to 850 at 3 p.m. And then it just kind of gave up, and it still hasn't even gone up there. So just be careful out there. I do see a lot of people mentioning REDBOX, but like always, guys, understand that these are going to be high risk, high reward type of names. That's why I didn't trade it today. As soon as I saw that downward halt and then an upward move, I was like, yeah, I'm completely hands off on this. We'll see what happens like that. I'm still in Twitter, guys. I'm going to keep watching this, guys. We've been in this since 46. Did take some profit yet on Friday into that kind of retrace with the market, but we'll see if this can continue on up. A lot of comments coming out of Elon. All right, let's go ahead. Let's get into our interview. We're going to go ahead and dive right into that when we return. Let's go ahead. Like always, guys, smash the like and let's keep it going here.
I tell all my CEOs, this is a very, very, very important platform. And look, all the other platforms are important too, but you're up there now. You're way up there.
Best investments you can do in your future is actually go and re-educate yourself on credible sites and credible resources like Benzinga. I think you guys have been killing it.
The comment section on this show is remarkable. Like the quality of the combo, and just big shout out to you and your community.
So I love about you guys, you just had all your callers in right then. And it's all about the community here at Benzinga.
All right, let's go ahead. Let's dive in our interview here with Sam Stovall, the Chief Investment Strategist at CFRA Research. How we doing? Welcome to the show.
Great. Happy to be here. Thanks for inviting me.
Definitely. One thing I definitely looked into was your book, and I do have the link down in the description. If you guys want to go ahead and check that out, we're going to dive into that conversation at the end, and I think it's a really fun one to touch. But let's go ahead. Let's talk about market environment that we're going through right now. One of the things that I did see was a recent interview that you did before 2022. So I have to give you a little bit of props there. Definitely, you guys stated that you were looking towards a volatile 2022. Of course, we could see probably dead on target on that one. Now, the real question that I have for you is, how do we look at the rest of 2022?
Sure. Well, 2022, the reason I said that I thought it was going to be volatile is that it is a midterm election year. I like to call them sophomore slumps. And historically, we have had 40% more volatility in that midterm election year when compared with the other 3 years of the presidential cycle. So history basically says prepare for volatility. We don't know exactly what's going to cause it, but we do know it's coming. Also, if you look to what happened last year, the market was up more than 26%, almost at 27%. And whenever we were up by 20% or more in a particular calendar year, we ended up digesting much of that gain in the next calendar year. But the good news is, if it started in the first quarter, every one of those years got back to break even before the year was out.
Yeah, one of the things that I saw in your bio was that you're an expert on market history. I think that's awesome, because one of the things that I've been trying to do is look back in history and see if there was ever a time like this before. Do we have a market environment like we're in? Can you recall in a market environment that was kind of similar?
Well, nothing is exactly the same, but when I look to four factors right now, look to the fact that the Fed is in a rate tightening mode, that we do have an inverted yield curve, depending on whichever maturities you're looking at. We are looking at a geopolitical event, and there's the possibility of a recession to occur within the coming 12-month period. Whenever we've had those four factors together, we have fallen into a bear market. A year in particular that sort of reminds me of that is 1956. We did have a rising Fed. We had an inverted yield curve. We had two geopolitical events. We had Gamal Nasser seize control of the Suez Canal, which prompted a military response by England and France. And we had the Hungarian uprising that was then squashed by the Soviets when they rolled their tanks in. So very interesting how Ukraine and Russia are similar to Hungary and Russia back then.
Wow, I gotta say you hit that right there. I even wrote it down. I need to go do a little bit more research on 1956. I will take a look into that environment. And like you said, there's never two moments that are the same, but it definitely is interesting to definitely know about the history and how things reacted back then. Now, one of the areas that I have been seeing, of course, is, and it's a talk with a lot of what's going on, is the NASDAQ and tech stocks taking a hit on valuation. A lot of this largely due to the increasing interest rates, but also a forward outlook, right, on earnings. Where is really the earnings supposed to be? Now, one of the things that we have been seeing is, do you still see these tech stocks at overvalued, or they start coming back down to some kind of, we could say, some down to earth evaluations here? And is there any financial indicator that you kind of focus on? Is it kind of earnings per share? Is it is it sales to book? What do you like to look at?
Well, I like to look at a variety of things: earnings, revenues, profit margins, etc. But I also look to interest rates. I think if there was one indicator that investors, if they could only look at one, it would be interest rates, because that is the discounting mechanism of future earnings, future cash flows, etc. And there is a negative 0.5 correlation between the 10-year yield and the PE on the S&P 500. So when we saw earlier this year the 10-year yield creep from 1.52% up to now almost 3%, it's not surprising that the high PE groups of communication services, consumer discretionary, and tech took it on the chin, because they are the most vulnerable to higher interest rates. Yet what's interesting is that if you look to what is the average PE on forward 12-month earnings for the S&P 500, we're still about 5% away from that. So meaning we have 5% more to go to the downside just to go back to an average. Whereas tech has already fallen to the point where it's only about 1% away. So I would tend to say, whichever group looks more beaten up at this point, it's probably tech versus the market itself.
Interesting to note that. Now, one of the recent rotations that I have been seeing changing is the basic materials. Don't know if you caught that. And is this really a commodities bubble? I know that a lot of people were calling it that. And do you feel that the inflationary trade has died down here, or are we simply just seeing kind of a pullback in time here?
Well, I think we're seeing a pullback in time right now. A lot of people are very worried about this decade being similar to the 1970s. In the 1970s, we started the year or the decade with a year-over-year gain in headline CPI at 5.4%. We ended the decade at 12.4%. And not surprisingly, we ended up with an anemic 1.6 compound annual growth rate. So people are very worried. Could this be the 70s all over again? I hope not, because I can't fit into my leisure suit. Also, what I found was that energy and materials were the best performers. Also, along with that, were some of the defensive areas, in particular utilities, but tech and consumer discretionary were the worst performers. So I think we have to wait for Wednesday's Fed meeting. We have to wait for the April CPI numbers. Our belief is that we peaked out in the March reading at about 8.5% year on year, and that we will be experiencing a slow whittling down of that year on year climb. But if we're wrong, then I think that investors will continue to be very worried and focus on the inflation hedges.
Definitely something we're going to all keep watch on Wednesday. One of the things that I do, and I love to do it, is sector and industry analysis. I always say, let's try to work backwards, then forward, right? And so I would love to learn maybe some tips for our audience and for retail traders out there. How could we learn more about sector analysis? And is there any tips that you could give us, Sam, so that retail traders can keep pushing forward?
Sure. Well, I written 2 books in my career. One was basically looked at the average sector rotation through economic cycles since World War II. So basically to say, depending on which sectors are doing well, you can get an idea as to where the investors feel we are in the economic cycle. And right now, obviously, with defensive doing well, investors are very worried that we are headed for not only a recession, but also a bear market. I wouldn't look at it the other way, meaning, trying to figure out where we are in the economic cycle and then say which sectors to buy or sell, because that's putting the cart before the horse. Prices lead fundamentals. So you look to prices to get a read as to what is likely to happen with the fundamentals. Also, I like to tell investors, if you are a nervous Nelly, then Clint Eastwood provided me with the greatest bit of investment advice when he mumbled through grit teeth, "A man's got to know his limitations." So if you are a nervous Nelly, then I would say embrace a rules-based investment approach, whether it relates to correlation, momentum, or seasonality.
I couldn't say it like you guys. Sam's killing it today. I'm loving it. All right, let's go ahead. Let's get into a little bit more fun, right? Let's talk a little bit about your book, The 7 Rules of Wall Street. I thought this was a really fun book, and it's really awesome that you did the actual research behind this. And so really what it does is it takes a look at some of the familiar sayings that we all hear in the stock market. And I wanted to take a look at 3 of them now to kind of just talk about them, especially the last one. I can't wait to talk about it. But let's go into this first one, because I think it also represents a lot of what we're seeing now is as January goes, so goes the year.
That's right. Well, I learned that one from the Stock Traders Almanac, which is a great publication for investors to look at, just to look to patterns, what typically happens from a seasonal perspective before and after holidays, never sell on a Monday, things like that. But as goes January, so goes the year, gives you a pretty good idea as to what is likely to happen through the rest of the year. If the market is up in January, it continues to rise about 85% of the time and has posted an average 11-month return of about 11%. Whenever we've had a down January, as we did this year, whenever we had also a negative first 5 days of the year, which we did this time, then that usually sort of implies, things could be troublesome in this calendar year. And so far, it's spot on. So I would tend to say that look to January to get an idea as to what investors are thinking for the year ahead.
Something we definitely got to keep in watch. Now, this is an area where I run into a little bit of weakness. You got to always know your strengths and your weakness, right? Like you just said, the limitations. Now, letting your winners ride but cutting your losers short. This is one of those that I do see on both sides. I've tried to let the winners ride sometimes, but I always feel like it's always about more about the rotation. But I'll let you speak about it, Sam. What did you learn about it, and what did the data tell us?
Sure. Well, in many ways, I borrowed from the research done by James O'Shaughnessy in his book, What Works on Wall Street. He published that in the early 1990s, and it still holds true. It basically says, if you are looking for a rules-based approach, you are better off looking at your winners rather than looking at your losers. Think about it this way. How many people who own a stock that's hit a 52-week high are disappointed? None of them. How many of them are going to brag about the stocks that they have to their friends who might not do the research? They'll buy into it and, in a sense, keep the momentum going. I look at a very simple 200-day moving average between the sectors within the S&P. And essentially, if you own the top 4, look at them at the end of each month, look back 40 weeks, 200 days, 9 months, pretty much the same thing. And you own the 4 best in equal proportions, and then you wait for the next month and say, well, what do I want to own now? Then traditionally you've outperformed the market, certainly year to date, but also over the past 3-year, 5-year, and 10-year basis. So a very simple approach is at the end of every month, see which ones are the winners on a rolling 40-week moving average basis, and those are the ones you want to emphasize.
Hey, I have a friend that Joel Condon says it always: kiss. Keep it simple,
Yeah.
stupid. You sometimes try to complicate things. Now, the fun one here, and I mean, it's definitely fun because it's definitely the date right now, is sell in May, then walk away. This is, I think, I heard it all throughout the day, so I felt like I had to touch it here. What did you learn about this one, Sam? And are we selling in May? What are we doing?
Sure. Well, I mean, that old adage goes back centuries: sell in May and go away, do not return until St. Leger's Day, which is a horse race in England in late September. However, if you look to, again, keeping it simple, rolling 6-month returns, what are the best 6 months of the year? What's the worst 6 months of the year? The best is November through April. The worst is May through October. Why? Well, I think it's because of capital inflows. Pension funds add money early in the year. If you get a bonus, you tend to get it by the end of February and invest much of that bonus. If you have an IRA, you have to invest by April 15th. And if you're getting money back from Uncle Sam and you don't use my accountant, you tend to file early and put that money to work. In the summer, you basically focus on your TANs more than your portfolios. The third quarter of the year is the weakest, primarily because of the window dressing that takes place in September for mutual funds that have fiscal years that end in October. And also with all of the volatility that traditionally occurs in October, investors are spooked by that movement and basically say, I'm going to wait until November to get back in. And it does very well. However, when you look at it, the S&P's return since 1945 is 1.7% May through October. Since 1990, it's about 2.5%. Both of these numbers are better than what you would get by going into cash. So I have found that if you rotate rather than retreat, meaning go into consumer staples and healthcare, and for the 6 months of May through October, and then into the more cyclical areas, November through April, you've beaten the market about 70% of the time going back to 1990, and have done so by a fairly considerable amount. And if nothing else, you're still in stocks. You're just in the roller coaster from November through April and in the merry-go-round from May through October.
Definitely something we'll definitely keep on watch. I know that a lot of investors have done, like you said, the tax returns come and we just throw it into the account. And now has been that time where I've been like more like, man, I gotta kind of hold a little bit of that money to use it throughout the year, not always just the beginning of the year, but something we'll all keep on watch is, of course, that sell in May, then walk away. Does it work this year? Does it not? Sometimes it does, sometimes it doesn't. I mean, we'll all definitely keep on watch. Now, one thing I definitely have to do is thank you for joining us here on Money Mitch, giving us some great information. We talked about the environment right now. We also talked about some tips that you guys can keep working to kind of benefit and keep pushing your skills as retail traders in sector analysis. And of course, check out that book, guys. I put it up in the description below. You guys can click the Amazon link and check it out yourself. Thank you for joining us. Sam Stovall, the investment research, the chief investment strategist at CFRA Research. Thank you for joining me, Sam.
My pleasure. Thanks for having me.
Thank you. All right, guys, there you guys have it. Another great interview here on Money Mitch. One of the things that I'm going to try to do more is get to the experts, because that's what I want you guys to learn from. At the end of the day, you guys see me doing my sector and my industry analysis every single day, but working on my skills to get better and where we can definitely learn from are the experts that I'll be bringing on this show. So you guys stick around, hit that subscribe button, hit that bell down below so you guys can be notified when we go live. We're going to definitely be active at 4:30 now. I had a little bit of a vacation time, hit the ring on, the Lord of the Rings, you can't take it off after that. So I'm here to make some money. I hope that you guys are here to keep working towards our benefit and growing our skills, whether that be doing sector and industry analysis, whether that be kind of catching some momentum strategy. You guys saw today, REDBOX kind of didn't work on out, but hey, I did take a great trade on Blue Apron. So I hope that you guys caught that. That was on the live trading stream. So if you guys didn't catch that, hit the video after, and I'll see you guys next time on Money Mitch. Until then, tomorrow we got another great interview, Mark Yusko. So smash the like. Let's keep it going. And like always, guys, I'll see you next time right here on Money Mitch.